All right. So to cover what I was talking about with my double diagonals here from last week, I kind of did a couple of different experiments here, and to see what worked out better, I was looking at hedging. If it gets outside of the mark, so I'm gonna keep this video as short as I can, but there's a lot of information here. We'll start with the diamond here, DIA. On this date here, I'll show you what trades I had opened on that. So I had bought the December 21st, 260 call, 240 put, opened that on the 1st. Against those two, those are longer term expiration. Against those two, I sold the weekly to November 9th, 258 call and 245 put. That means there was a $500 risk on the downside and 200 on the upside. But of course, if you remember some of the previous videos, that risk does not come into play unless it's way outside of that. So I do want to figure out though some ways to hedge that in case we do wind up in that. It's kind of the same as doing like an iron condor with the same expiration, except doing these staggered expirations like this actually decreases where your max loss is at, and it helps your break even and everything too. So it's a really good setup. So here's the marks where I said open this on the 1st, which was right here. We broke above that. I thought, well, that may run a little bit. And of course, after elections, we had that gap up, and we went up since that. So we broke up above that. So this was the 258 right here is where I had sold that. This one obviously is safe. That one's fine. Once we got to 258, what I did on this one was I bought another call on this. I did the following week, not the 9th, but the following week, November 16th, 258, the same strike that we just overran, okay, because I took in a credit of $87 for this one. That means I'm going to have to wind up buying that back for more if it's above 258, okay? 245 put, that one's safe. That's 125 to keep that one, okay? So see how that's starting to offset that already anyway. But the stock can't be in two places at once. So the reason I bought the following week is because if it expires right at 258, this one obviously would go to zero. I would keep that one, but your theta on the last week is higher than the 2 weeks out. So I know this one isn't going to be closing it worth $0. So the reason I bought that one is just so that I had something to close back out and I'm not losing 100% in case it does reverse, which is what it did wind up doing. So, but anything above 258, well, anything above 260 would technically be where your losses, or anything above 258 expiration is loss, up to your 260 is where it starts increasing. So you own this one though, so that starts increasing. That offsets that a little bit, and I'll show you a chart here in a minute on that too. So once it got to 258, what I did, and I remember what day that was on, that would have been on the 7th, so be Friday, Thursday, Wednesday. Yeah, Wednesday I bought that. I bought November 16th, 227 is what I paid for that one then, okay? So now what happens is my delta on this one and this one offsets my loss if it continues. That's my concern, is if it continues, that's where you start getting your loss. Now, if it kind of peaks above 258 and retraces, closes back underneath that, if you got a couple days till expiration still, then you're fine. You're going to keep all of that. But what if it keeps going? I don't want to lose, $200 on this trade, right? So that's what this did, was it offset that. Now, how I managed that was a little tricky here. So there's 258, 259 there, because it did kind of dip back down below, we touched 258.79 again. So I wouldn't have ever been able to keep 100% of that 258 call that I had sold. But because I had these two, where it would have been the most profitable is once it kept running up into here on a Thursday. Most of your time decay is going to be bled off on this one that you sold originally. I think there was like $19 remaining in just extrinsic value on Thursday. So probably what I should have done was close that one out on Thursday and sell both of these calls too. So the December 21st and the November 16th call, I would have had a little bit more profit there. But just doing the straight double diagonals, I would have actually been sitting at a loss on Friday with that. So by adding this extra hedge here, once it hit my strike and overran it, by adding that extra hedge, I actually took what would have been a loss. And then here we go. So my total cost of everything in, including the hedge and all this stuff, was 636. Still sold it at 771. So we still had a 21% gain on that. And what's really cool here, obviously you've got, if it stayed in between these strikes, you're going to make money. But my question is, okay, once it overruns that, are you just stuck with the loss? And that's why I've been kind of looking at some different ideas on how to fix that. So normal profit right in here. When it exceeds, I still figured out there's still a way to keep profiting from this trade, even though it is overran your strikes where you should have a loss, by adding one extra call to the side. So obviously we don't have to worry about the put side at this point. You can really just close that out. And this one's not going to be worth anything. I bought it back at $1. I think it was actually technically half a cent or whatever it was trading at. So I bought that one back. This one I did have to buy back at 175. I originally took in a 87 credit on it, so I do have a loss on that. This one here, originally I bought for 319, sold at 525, obviously because it was higher. I had a gain on that one, and this one went from 227. I closed that one out. That's the hedge that I bought for $3. Now my put, obviously, I sold at the loss. It was 302 is what I bought it for, sold it for 122. So I'm just putting when I close them out above and below these here. So, but yeah, all in all, still, $135 gain on a trade that, the way I had been doing it, technically I would have taken a loss. So I actually was able to turn that into a gain. Now on the SPY, I did something similar. I think here's my difference here. Instead of adding like this one on Diamond, I added just the following week. This one I added another one of the long calls that I had. So I had two of these then. So obviously your cost to buy that's a lot higher. We bought that for 406. And the other thing I probably did on that would have been I actually bought it right in here. It never quite hit 280. Looking the way the markets were going, it looked like it was going to kind of keep running, and it did really for that day and the next day, but then it reversed too. So what I wound up with it here was I paid 406 for that second one. I only paid 308 for the first one. So you can average those out, 357 or something. I bought that second one at 406. I think the stock wasn't quite at 280, so I think I got in a little bit earlier. But had I waited, I actually would have paid more for that. I would have probably paid 450, and my sell price still would have been 321. So I actually, if I waited until it got to the 280 call, I probably would have taken a little bit more of a loss on that than what I did. So I'm not convinced. I think I've still got to test a little bit of that, but I'm not convinced that doing a second one of these long expirations is the best way, because my plan is when I bought that there is I'm going to close it on Friday. I'm not going to hold that any longer than that. In theory, if it bounced there and went way back down here, you could still hold on to that, and then next week you could sell two calls against that. That's if it completely reversed. I don't know if that'd be the best strategy for that or not. I think I'd rather just close out the trade and call it done then. But your goal is you want it to be back below 280 and above 265, which we did wind up with, which means this one I was able to buy back. I originally sold at 49. I bought it back at 6. So it's a pretty good return there. This one, sold at 47, bought back at 1. This one I originally bought at 308. This is the long expiration call I bought. Sold that for 365. A little bit of profit there. Didn't close that one. I should have probably. So, but I kind of wanted to hold these into a later day Friday just to kind of see how all this played out. The ideal scenario where I wanted to test was, it breaks that area, it goes up, and then comes back I know if it kept going, it's going to become even more profitable. But my question was, what happens when we get back into below the strike then? So that's what I kind of seen here. The put side, I bought the 263 put for 350, closed that out for 220 then. So a little bit of loss there, but all in all, if you add all these up here, my total cost was 968 and sold all of them for 907. Now, that seems like a lot of risk, but like all of this stuff, I'm not holding this till expiration. I'm just doing this week to week. So these can't both go to zero, obviously. It can go one direction or way the other direction, up or down, but it can't be in two places at once. So one of these is always profitable. Basically, these two will pretty much always offset each other if it climbs or goes down, minus whatever theta, whatever time decay you have on it. Kind of the similar thing here too, but since you're going to have to buy one of those back at that date, you do kind of have to hedge that if it gets out of bounds there. So all in all, looking at this, I think doing the adding a call at the same strike that it's overrunning for the following week seems to be the best bet. I think this would have played out a little different if I had waited until SPY got all the way up to 280, but I was buying out of money call, so it actually saved me a little bit of money there. It looked like it could overrun that, and it did, obviously, a little bit. So I wanted to protect in case that. My max loss on that would have been, it would have been 200, but like max loss 200 actually would have been up in here. So we would have taken $150 something loss right there anyway. So what that wound up amounting to was that loss actually was only at 6%. Remember, we were 21% gains on the other one. So 6% was $61 loss. So between these two trades, down 61 on that one, up 135 on that one. And actually, this one last week I sold another set of calls and puts against that same trade, and I just kept the long expiration of December 21st. And actually I made 205 on that last week, and then 135 this week. So that's $340, and got one loss of 61. So that's for the last 2 weeks of doing these double diagonals on just the ETFs. And the reason I'm kind of starting to lean towards the ETFs is I don't have to worry about upgrades, downgrades, some sort of stupid news that causes it to go way up, way down. With ETFs, it smooths everything out a little bit. I don't have earnings to deal with. Open interest, well, at least on SPY, open interest is a lot better. You can see that the open interest numbers here on this is crazy. The open interest on Diamond, you got to watch a little bit more depending on your expiration. Like December, what was it? December, there was one I was looking at, didn't have much here. 14th. Yes, yeah, it's pretty low there. The 21st is fine. That's the monthly expo. The 28th, there's almost nothing, so don't do that one, obviously. 31st, there was a little bit more. That's just end of the year. And then January is a monthly, too. So you do want to pay attention to those just a little bit on Diamond if you're doing that trade. But let me show you what I was working on for the following, or for this upcoming week, too. I can't find anything that I like just perfectly here, but looking at this chart here, I think we're going to wind up going up to, I think our implied move was, what the heck was it, $4.50 something for the 16th. Yeah, so 470. So I round that up usually, and then it usually falls within this anyway, but so we'll say 265 on the high side, which is right up here. That's resistance. That would be a good area. Because we're here now, so that's got to make a pretty good move to get up to that. And then 255 on the low side, I think you'd have we got a little bit of support. I would say, well, we've got the 50-day moving average, and then we got 256. I would say that would probably be safe. I would be more concerned about the upside here. Probably. You never know how that goes, though. So that's the trade I'm kind of looking at setting up. For this next week, it's selling the 265 and the 255. Your credit on that's going to be, $100 on that. And that'd be on Monday. I may look at getting into that. What I'll be doing here is I'll be buying the December 21st 251 put and December 21st 268 call. Or if I change that to 260 now, it looks like, see, it skews a little bit here, so that's why I'm doing 268. There we go. Okay. See how my profit went higher on that side. I want to keep it higher on this side. This isn't going to be a really profitable trade here. Look at the numbers. I'm not sure why I can't get this to be a little more profitable than what it looks like, about right in here. It's not going to make anything if it just sits flat all week. If it climbs up here, we might make 45 on that or $50 on that side. But same thing, if it overruns that strike, the one I'm selling, the 265, all I'm going to do is I'm going to go the following week and buy a 265 call, like if it gets up to that area. And I did the theoretical price on that too. We got to go 23rd. So what I did here was, okay, so we'll say, I don't know if you don't know how to use this on Thinkorswim, this is a great feature here. We'll say on the we'll do 22nd. If that jumps up by, up to 265 then. So we're going to sell that one. And here's something else you can do too. You can see, what's this going to look like each day. I'm looking at the 265 call right here. It's worth 84 on that day. The day before that, it's worth 104. So it's probably realistic to say that would be 84. It would have to jump up to that by Wednesday for that to be 104. So probably a little bit high on that. We're going to add this in here though. So let's do this. So it'll show you a little bit more there. Okay. So let's keep moving this. We'll say we have to buy that on Thursday. It hits 265 and we go, oh man, I don't want to be sitting on a loss. So what you'll do is you'll go ahead and buy the 265 call for the following week at about 84 cents. So your price would be right in here's 265. So that's where you would buy it. So see now what happens. Let me do this here at expiration, because that would just be like the following day. So now you're like, okay, well, I'm max profit on the put side. The call that I bought is profitable, great. The put that I bought, I'm going to be down a little bit on, but now we're going to own two calls to the upside. Okay, so that gives you a bias towards going up. So the thing's right in here. It's at 265, and if it keeps going, your profit dips down here a little bit, and then if it goes way up, I mean, obviously it will keep going up forever because you got those two calls. So disregard the fact that you're going to have to lose and buy this one back. You've got two to the upside now, so that gives you a bias. Now, in this scenario that it reverses, see that's what we had happen a little bit this week. Your profit does come back down, or you can get into a loss there again too. But see, look what our loss does. Yeah, we're still, here's our 65 loss, and then I mean, it's not going to reverse that much in one day typically. So anyway, I think hopefully that all makes sense. But I've got one set up I already entered into for next week for SPY's 451. That's my total cost into it. I went ahead and sold the I was still hanging on to the 282, so I sold the 280 call, and I just kept that one open and sold the 266. So buy power reductions, 300 down. 282 on SPY, that it might overrun that again. So I'll do for the 280, I guess is what I sold, right? Yeah, I sold the 280. So right in here, if it overruns that again, I'm going to try the second. The same thing that I did on Diamond. I'll probably buy the 280 call for the following week then. So we might be able to even analyze that in here too. So if we go to, again, if you know how to use this stuff, it's pretty handy. Go to simulated trades. We're going to add the 280 call. Boom, there. That puts it right down here. Theoretical price, same thing. We're saying we're going to have to buy it at 274 then. Okay, so we're going to change this. 274, and then go back to risk profile. Boom, there. Okay, so if that is right there is what happens. You may still be sitting at a loss. This graph isn't going to show right because I've already taken some profit on last week, so that's minus your time decay. That's confusing, I'm sure, but so right in there would probably be break even anyways. But same thing, you got a little bit of a dip. If it overruns, keeps going, like we rally, we go up to 285 or something, you'll be sitting in profit, and it gives you some room on the downside. You're not going to have any sort of crazy losses now. So that's how I'm hedging and eliminating some of my risk on these double diagonals. So and if you go back through that 6% loss, that is my loss number 4 that I've taken on these. So but see, same thing going back. I did these double diagonals, 100% loss. We lost, well, that didn't cost me much of anything, but 100% loss. That one cost me 431. So that can offset a lot of your gains here, though, too. So that's what I'm trying to eliminate. This would have been a real heavy loss here, too. But only 61 loss. That doesn't wipe out much of anything. So, the probability of making all that work becomes a lot better whenever you can reduce your risk. So that's the way I'm kind of experimenting with reducing that risk right now. If double diagonals don't make any sense, go back one. Credit spreads is probably what you would learn before that. Prior to that, you would probably be learning, just vertical debit spreads. And then obviously the most basic thing, just straight calls and puts, but kind of work your way up to that stuff. This is kind of an advanced way of doing this. One of the things I really like about it, though, I don't have to babysit the trades. It can go up, it can go down. I don't really care. Like on Diamond here, I opened it here, it kind of went up, down, whatever. A few days later, it's still sitting there. Actually, that's when I closed out my last one. It kind of bought it here. A few days later, still kind of trading in here, closed out profit. So I'm not trying to directionally trade it. I'm just saying, it'll probably be within here and here. Now, obviously, this one was wrong, but I took my strategy where I was wrong and fixed it and still made money even though I was wrong. So what's good is you have the ability to make money from here to here. You just sit, you do nothing. Time decay works for you. But then I've got, something I'm adding in here, even if it does overrun where you're going to lose, now I've got a way to fix it. So if you got any questions about any of this stuff, obviously, post or send me a message. I'll help you the best I can. But definitely come check this out in the trading room on ChartSharks, and we'll see you there.